Hi friends, welcome back to Murthy Finance Academy. Today we will be discussing companies from NBFC. One is Capri Global, other one is Fedfina. Let us start, but a small disclaimer, or any company which we are discussing in this video are purely for educational purpose. Please do not take it as a buy or sell recommendation. So the Indian NBFC sector is currently navigating the mature phase of retail credit cycle, characterized by intense competition in secured segments and a tightening regulatory grip by the RBI on unsecured exposure. As the interest rate environment begins a gradual descent, evidenced by recent MCLR reduction trends, the primary battleground has shifted to gold and MSME lending. The Indian stack has transitioned from a competitive advantage to a baseline requirement, forcing a divergence between legacy branch heavy models and platform centric lenders. We observe a structural integration of credit from the informal sector to formal NBFCs, yet this growth is coupled with rising operational complexity. Institutional valuation is no longer a function of AUM growth alone. It is now a function of how efficiently that AUM is serviced and how resilient the collateral remains against commodity volatility. So the analysis contrasts Capri Global and Fedbank Financial Services Fedfina. While both exhibit a high concentration in gold and loan against property, their execution styles represent opposite trends end of the NBFC spectrum. Capri is pursuing tech-led hypergrowth with aggressive AUM targets, while Fedfina is prioritizing the cleaning of its earnings profile by moving away from direct assignment income toward core net interest income. So, if you see the AUM growth disbursements, Capri Global is having a higher AUM growth of 46%, and Fedfina is recorded an 18% year-on-year growth. And cost to income ratio also for Capri Global, there is a reduction and it got down to 51.6%, and Fedfina remained stable around 58%. And even the net interest margin, which is a key parameter, stayed for 7.8% for Capri Global, and for Fedfina it is around 8.5%. Even the gross 3 slippages ratio for Capri Global it is at 1.2%, but for Fedfina it is at 2.1%, which is on a bit on a higher side. So if we see Capri Global in depth, so Capri Global has successfully decoupled its growth from physical footprint. By transitioning into a platform-centric NBFC, management is betting on tech-driven operating leverage to reach a massive 55,000 crore AUM by fiscal year 2028. So the AI native claim is substantiated by the data. Disbursements grew 87% year on year, while manpower increased only 19%. This drove the cost to income ratio down from 58.2% to 51.6%. And despite the strong GS3 of 1.2%, stage 2 assets increased by 95 crores this quarter, reaching 4% of gross loans. This suggests potential forward flow stress that warrants close monitoring. And the resignation of CEO Monu Ratra within the 4 months of appointment is a forensic red flag. While management claims no impact, high-level key management personnel churn during hyper-growth phases often precedes shifts in underwriting standards or internal friction. And with a portfolio loan-to-value of 60%, Capri Global has a 15% absolute cushion before hitting the 75% regulatory cap. The 14-day margin restoration trigger via the Spark or Orion stack is a necessary defense against the liquidity of gold. So if we quickly see a valuation analysis of the Capri Global, if the company is having AUM of around 58,000 and target ROI if it is reaches to 4.2% in a bull case scenario, there could be a rating upgrade to AA plus micro lab at around 24% yield becomes 15% of the mix. In a base case scenario, if the AUM reaches 55,000 crores and ROA is reaching at around 4%, so there could be successful stabilization of 1,000 gold branches spreads at 7.2%. In a bear case scenario, if the AUM reaches 48,000 crores and a target ROA of 3.5%, so stage 2 to stage 3 migration exceeds 20%, gold price correction hits 25%. Now let us come to Fedfina. So Fedfina is currently in a consolidation and quality phase. The company has moved to a 99.4% secured lending portfolio, effectively exiting the unsecured business loan market to mitigate credit risk. So if you see the company, there is a massive reduction in DA income, which is nothing but direct assignment from 62 crores to 1 crore is the most significant detail. While it suppresses optics for PAT and revenue in the short term, it eliminates lumpy fee income in favor of core interest accrual. This improves the durability of the balance sheet. And management has acknowledged localized stress in the small ticket LAP segment, which are loans between 5 to 7 lakhs less than. The rise in GS3 to 2.1% is largely driven by MFI slipover. We view the cautious stance in Tamil Nadu as prudent, but it will drag on AUM growth in Q4. The addition of 113 branches has created an OPEX gestation drag. Furthermore, the 3.9 crore labor code impact and higher staffing costs have kept the cost to income ratio stagnant. Its branch productivity, which is around 13.3 crores, must move toward 15 crore to achieve operating leverage. If you see the core strengths of the Capri, strengths includes 87% disbursement growth and AUM A2 stack. For Fedfina, it is 99.4% secured book and Fitbank lineage. And coming to weaknesses, the gross stage 2 assets for Capri stood at 4% and CEO volatility. And for Fedbank, ST Lab stress in South India and OPEX drag. And coming to opportunities, micro lab scaling, which yields 24% yield, is a clear-cut opportunity where Capri can focus on. And coming to Fedfina, the tonnage growth, which is around 5% year on year versus value growth, need to be considered as an opportunity. Coming to threats, tech obsolescence, gold price correction could affect both the companies. And if you see a basic scenario modeling of the valuation modeling for both the companies, on a bull case scenario, Fedfina reaches AUM of 22,000 crores, ROE will be 14%. If branch productivity reaches 15 crore plus and Tamil Nadu issue recovers fully and NIM expands on rate cycle tailwind, quality metrics justify re-rating. In a base case scenario, if AUM reaches to 18,000 crores, ROE reaches 12%, there we can assume that steady secured AUM growth and gross stage 3 stabilizes at 2 to 2.2% and branch productivity gradually reaches 14 to 15 crores, we can hold or mildly accumulate. In a bear case scenario, if the AUM reaches 14,000 crores and reaching ROE of 9%, if Tamil Nadu contagion spreads, GS3 rises past 2.5 and branch expansion remains a cost liability, NIM net interest margin can be compressed by rate cuts. If you like this video, please like, share and subscribe. Thank you.